Welcome back to another podcast. So I'm joined with Michael Harvey today, and I'm Josh Kozis, or Joshy K. And we thought today we'd start, I guess, dispelling some of the myths or common questions that we've seen from clients following the federal budget.
Yeah.
In May.
Yep.
So I guess, what have you seen as in the accounting space that people are starting to ask?
I think by natural reaction, everyone thinks everything's happened already.
Mm-hmm.
And so some of the announcements have been legislated, so we now know what they are. Some of the announcements are still out for discussion, and some of the announcements are still being negotiated with a few different outcomes. So I suppose we deal with the knowns out of that cluster, which is the negative gear. So just, I suppose, to re-emphasise what negatively gearing is, so that allows people with losses on their rental properties, investment properties, to offset that loss against other income in their tax return. So they get a tax credit or tax offset. So what's happened there is that that's from budget night that got outlawed, but didn't mean that all the existing properties you can't do. So I suppose the important point is, if you had that scenario as at budget night, it's grandfathered, or it's locked in that current old arrangement still applies. So there's no change there.
Yep. And grandfathering meaning that they're going to honour the existing arrangements that people have had, rather than going back in time and changing the rules.
Yeah. Negatively gearing is a funny scenario anyway, because effectively you're losing money in paper. One of the, I suppose, the methods were, typically it was maybe a more newer property, an apartment, something like that you would buy, have a depreciation report prepared on it, and therefore you claim depreciation, which is a non-cash item, claim depreciation as a tax deduction in tax return, so show the tax loss. So that was typically, I suppose, the scenario for a lot of negatively geared properties. That has been abolished for any new properties you purchase after budget night. So that means that if you have that loss, you can carry that loss forward. They can't offset that loss against your other taxable income. That changes some of the strategies of the types of properties people may want to invest.
Yeah.
But I suppose the main message you give for existing properties is no change. So.
When you say new and existing, I guess that's where the terminology comes in. You're saying existing as in I already owned it, not existing as it was already built, or new as in...
Yeah, so good point. So if you owned any property at budget night, no change. After budget night, if you purchase a property, then if you purchased a new property, then you can still do it. If you purchase an existing property, but new to you, then you can't use negatively gear.
Yeah,
can't negatively gear on your tax return.
Yeah, and that's been the key. I mean, my key takeaway has been the nuance in the words that we've used throughout the budget, because sometimes you use one word that means something slightly different, which could have drastically different outcomes for people.
I think from memory, when the legislation went through, one of the outcomes was of unintended consequence in the way they drafted the legislation. If someone went through, I think, like a divorce, matrimonial issue, or estate, then it could create an unintended consequence. And I think the government have announced that they'll sweep that up and fix that anomaly at some point in time.
Yeah.
Acknowledge that wasn't the intent of making subsequent change through those scenarios.
And more things may trickle through that they need to match that up a little bit. That's why they give it such a good grace period, I suppose.
Yeah.
Yeah. So they're the common ones. So the question the client might ask then, given that people think it's all legislated, is does that mean I should sell my property now? Have you had any of those?
Oh, lots of people say, is this all too hard or too confusing, or I just have to sell now. So if we move probably and bundle that change with the change in the capital gains tax rules. So we're talking predominantly about property, but it's important to note it's across all investments, all types of investments. That the so the rules on all types of investments mean that the old method which is still the current method. I should rephrase that. It's up until June 2027. There's no change. So negative gearing is a change in budget night. The CGT or capital gains tax rules, there was an intention to change in the future. The intention to change is scrapping the 50% discount. So if you bought something for $100, sold it for $50, made a profit of $50, it'll give you a 50% discount. So you pay tax on $25 in that example. That will still apply up until June 2027. And then what happens is the tax office have said you can either get a valuation done at that date or apply some indexation formulas and then come up with a value of that property at that date. And the 50% discount rules apply from your purchase date up until the valuation date of June 2027. So
there's two calculations.
So it's kind of a mess of the calculations, but in terms of should I sell my property and not have to adopt the new rules? Well, yes or no, don't drive your behaviour by that because it's not the end of the world. June 27, you should all those capital gains to that point in time get calculated under the current rules, which will become the old rules in June 27. Mm-hmm. And then from 1st of July 2027, then the CPI indexation methodology will apply for any gains that happen after that date and any gains above the valuation we have that you get done at that point in time.
Yeah. So valuers are going to be quite busy.
If you want to start a business, start a valuation business.
Not a bad.
Yeah.
What I always like to cover off on is what gearing is. So you loosely touched on it, and I think it's a bit of a buzzword. So when I hear people sitting around at the pub, not that I go to the pub very often, but as an example, they go, negative gearing is such a good investment. And like you said, negative gearing means you're losing money on a cash flow basis. So all gearing means is you have an asset with a liability attached to it. That's all that means. If it's positively geared, it means that it's making you more money than it's costing you.
Yeah.
Neutrally geared, it breaks even. Negatively geared, costs you more money than it's giving you. So the question becomes, if I'm paying $25,000 in mortgage repayments and only getting $20,000 in rent, why is negatively gearing even a good thing? Because it says I'm losing $5,000 on paper.
Yep.
Now, previously, it's been because maybe that $500,000 asset becomes $520,000 through growth.
Yeah.
So you say I'm in front by 20 as capital, I'm minus 5 through cash flow, I'm still in front by 15 as part of my overall wealth.
Yeah.
So that's why people were using negative gearing.
Yep, that's right.
But as you approach retirement, it's not the same for everyone, so keep things general, but as you approach retirement, typically you want to move to income producing assets, and so you're flipping from negatively geared into positive geared.
Yep.
Yeah, because your assets should still be going up and rents ideally would still be going up as well, and your liability should be coming down, or the cost of servicing it.
Yep.
Yeah. So I like to just wrap up here.
Explanation, Why would you have the intent to lose money?
No, unless it's for your kids or something. Typically we don't get into investments to lose money.
Yeah.
What about property in general? Is property investing dead?
My personal view is no, only because the underlying demand is still strong for housing in Australia versus they're getting built. Mm-hmm. So basic economics 101 tells me that
supply and demand.
Supply and demand means that there might be some short-term consequences in terms of, from what I can tell, just reading the headlines out of, say, the Melbourne and Sydney markets, the auction clearance rates are down because people just go, I'm not sure what's happening at the moment.
There's a lot of uncertainty.
And it's coupled with the interest rates have gone up a couple of times, forecasts of maybe one or two other rate rises, so people go, maybe I'll slow down for a minute.
Yeah.
So you got those headline numbers, you got the reality in the short term. The government had a sort of a statement that they're trying to make property more affordable for people, which may or may not happen. I don't know, these manipulations, if you want, by government policy, I think just work its way through the system over time.
I think it's a bit of noise.
And it's true, short term, if you bought a property in April that might have taken a dip in Melbourne or Sydney, the stats don't lie.
Yeah, and depending on when you were going to sell it, that either will or won't impact you. If you had a 20-year holding pattern, likely very little impact on it, but it does affect, we talk gross and net year, you'll hear us talk about that, and investment returns are often dictated or shown through gross returns. Because of these tax changes, it's going to change your net return, but that
Yeah.
doesn't necessarily mean that property is not going to have a investment return for people.
Yep, that's right.
So really, it's a tax change. Does that change the quality asset? Obviously, when you go down different streets, the quality of the house changes. So
Yeah.
Personally, I don't feel like property is dead. Investment,
No.
residential or commercial or
Yeah.
but it is a tax change.
It's tax change. It'll have short-term consequences, which may change some people's types of profile that they're looking for in an investment scenario. You talk about income yields versus capital growth yields, the negative gearing scenario. That they change a little bit over time. It'll go, well, the advantage of the capital growth story is probably been eroded a bit long term because I'm not going to get 50% discount for any gains that occur after 1st July 27, and then your income yield just get taxed at normal rate. So it'll might change a little bit when you crunch the numbers, but as you say, people just adjust over time. Go, oh, yeah, this is the new scenario. The numbers stack up or not. So.
Yeah, that's a good point. That's where it's so individual as well. Depends on your marginal tax rate.
Yes,
that's always with gearing, whether it's worth doing or not.
I think that's another little myth just to sort of trot out there, that people talk quite easily about capital gains tax, and a lot of people think it's a separate rate of tax, and it's not. It's
not a flat rate.
Not a flat rate. It's you make $100 from your salary and wage, and made $50 from your capital gains, and it gets all combined and taxed at your normal tax rate. So you can bump up a tax bracket because it gets combined in that 1 year, but there's no actual separate rate of tax for capital gain.
Yeah, it's a good. I mean, the analogy that comes to my mind, given the recent travel back and forth, is just because you have separate bits of luggage when you're traveling. I mean, you all get weighed the same. It all kind of comes into the calculation. There's not individual rates for different types of bags. It's just coming all in under one. So that actually leads me. We talked about the fixed rates. So that straight away, my segue goes to the differences in trusts, or what they're proposing with the fixed rate of trust distributions. So what are the changes that they've proposed as part of that?
So these are still proposal. The first two we talked about have gone through Parliament, so we know a lot more definition. So the proposal is what they call discretionary or family trusts, a lot of people call them. What types of trusts are they? So discretionary means the controllers of the trust, being the trustee essentially. They call the shots about who gets the profit. So I own a property in a trust, and it makes $100. I might say, I'll give you 50, Josh, and I'll get 50 for myself personally.
I'm happy with that arrangement too, by the way, because
but it's totally at my discretion. So in that example, if I'm the trustee, sole trustee. So that's what a discretionary trust is. Compare that to other forms of trust. So a fixed income trust. So you and I are in business together. So we own 50 units in that trust together. No discretion. We make $100. We have to split 50-50. So targeting the discretionary trust. I see those probably more as a property, a vehicle historically that's been for holding some investment properties, or actually a trading entity for a small business, say. So what they're saying is that they're not saying you can't use that trust, but you'll pay a minimum 30% tax on that profit, which may not be the end of the world in some scenarios, but if you have anyone essentially earning taxable income below $45,000, then minimum tax rate of 30 cents on the dollar, which applies for anyone earning taxable income over $45,000. Then anyone earning less than 45, they're paying too much tax. So it's sort of, like, I don't know, say my wife and I, we're about $45,000 each. We own a property in a property trust. Well, they changed to us because we gave a minimum 30% tax rate anyway. So
the story comes to my mind about the small business. Maybe you've got a partner who's taking some time off to have kids. And you think, well, to try and manage my tax, let me split some income between my partner and I. It's also fair that they get a bit of a wage when they're wrestling the kids 24/7. So they're the people who may
they'll be affected. So bearing in mind, this is proposed to take place from 1st July 2028, which is effectively the FY29 year, if you look at the financial years. So once again, no knee-jerk reactions required, but some bit of thoughtfulness about what you do own in trusts and what they may look like. Just a couple of caveats or carve-outs that we're aware of so far. So subsequent to the budget announcement, they clarified that testamentary trusts will be exempt. So a bit of commentary now about whether they come back into vogue. So testamentary trusts, just to clarify, these are trusts that get created upon the death of someone. So if I have a testamentary trust for my kids, for example, all that means is that I create a trust, or I nominate in my will, a trust gets created for my kids either individually or collectively upon my death.
Yeah.
So they're now saying they'll be exempt from the new rules. Unit trusts, which I explained before, which you and I have fixed unit entitlements, so therefore they're not affected. And that's also talking about primary production industry being exempt from these scenarios as well.
Yeah.
We'll wait for the definition to happen. So I only saw a headline maybe Friday or Monday that Treasury have put out a discussion paper about some of these proposed changes. It's a little bit like discussion paper. It's having responses by the end of the month, so it's not very much of a discussion.
Yeah.
But they're wrapping up some of the announcements that have been made, so that those sort of policy announcements that I just alluded to, as well as they announce some transitionary rules allowing people to restructure their affairs from 1st July 26, was it? I can't remember off the top of my head. But there was a 3-year transition period where they're saying, from my understanding, any unintended consequences in terms of capital gains that arise from restructure will be ignored effectively.
So whatever your cost base is determined to be, kind of just gets carried over to that new structure. And then
there was the cost base for that, and one of the unknowns, which I think where land will be unknown, will be, so if you do own a property in a trust, and I want to say to restructure it to personal name or to a company, historically state duty levied by the state government will be charged on any change in title. I'll wait and see if the state government comes to the party on any rollover relief in that space. Hopefully common sense may prevail, but we'll touch this wood a bit longer.
yeah, I need revenue.
That's right, it might be a revenue winner. So that's, I suppose, some planning will be coming up for people who are in that scenario going forward.
And who's the best person to reach out for that? So if you had a professional network, that would be your accountants to reach out to.
Yeah, I think it would be similar to a valuer. I mean, I'm biased as well. One of the businesses is an accounting business, but yeah, that's probably the best advisor and good place to work through a scenario, because, like you said before, it will be a case-by-case scenario to work through.
Yeah, it's not just your current circumstances. It's, well, what's your family circumstances going to be in the next couple of years? Because that affects it as well.
That's
maybe
right.
you take a slightly bigger hit to tax now, so you get better tax outcomes later, because maybe you're 5 years out from retirement, as an example. So you go, look, let's just take the bullet, and then for the next 20 years that you're in retirement, you've got your marginal tax rates. Maybe it changes things a bit.
And they have announced, I haven't followed the detail, but they did announce that the definition of small business for capital gains tax, the turnover test, so there's been historically 2 tests, so I'm sort of going slightly off tangent, but there's on top of the capital gains tax changes, which is what they call the general discount of 50%, they changed that. There's a whole series of other small business capital gains tax concessions. They have announced that the turnover test for that will rise from 2 million to 10 million. For that definition of small business, which is quite a significant change. And just with my client base, you've got a few businesses in that space that go, opens up a discussion of how we might restructure things as part of a holistic succession planning discussion. Fertile ground for meaningful discussions with your advisors, the accountants in this space.
Definitely. So overall, if you were to summarise it, does it change a client's goals necessarily, or is it really just tax, which is one part of?
It's only a tax change, it's only. For some people it's a significant change, but to me I would just say let's crunch the numbers, knowing what their rules are now. It doesn't necessarily change some of the underlying principles. It might change the category of properties you're invested in or how you structure your business. So if someone come to me today and said, "Oh, I want to start up a new business," I put the family trust option on the table with the asterisk to say here's some changes coming up, which may influence that decision. Someone already in that place looking at an investment side of things. As you said, just looking at net returns, the net returns in those scenarios might have changed with the changes in the tax laws, but
The positive return.
that's right, yeah.
And that's where, like, I've got a friend I was speaking to recently, and as an electrician, one of the reasons or driving factors for having the trust was really to try and separate risks from the business from the personal.
Yep.
That if a house burns down, he doesn't necessarily lose his house if the business has got trust in between it. And so just because the tax outcomes might have changed, that doesn't water down the main driver of that structure, which was around asset protection.
Yep, that's right, yeah. Just allows you to revisit what's the purpose of having that structure and is it the right structure for me? And the government prima facie are allowing some restructuring opportunities to take place and to revisit, but by the same token doesn't mean that, we have to change if it's still the right structure under the new rules.
Yeah, just educating yourself on what those impacts are so you can then adjust in other ways, because managing tax is something you can do beyond just the structures you're choosing.
Yeah.
Right? Like that's where superannuation might come into it. There's other things you can be doing.
I mean, this is a flippant comment, but I say to people that take this like an expense, a bit like, you always talk about bring your mortgage company up for, might be in the best interest rate, ring your telco up, might get that. Same thing. Am I being most efficient in my income tax expense? Still an expense that we need to be smart about, but it's an expense that you're going to pay at some stage. Yeah. So it's just factor that in. So.
Yeah, and they say you've got to spend money to make money. So reaching out to an accountant and actually getting good tax advice to save money, and then that fee tax deductible on the next year, which is always nice. Bit of a plug there.
I like your style there.
All right. Well, that was a bit of a wrap up. So it's really that the federal budget hasn't changed the fundamentals of making good investment decisions. You still need to consider things like tax, but tax is not the whole story.
That's right.
So it's really looking at those broader needs. So definitely encourage people to reach out to your accountant, your financial planners, make sure you're well informed. And if you've got any questions, you can reach out to the Financial Streams team.